The housing market in 2025 is shaping up to be a bit of a roller coaster, but not the fun kind. With mortgage rates staying high and inflation still making things tricky, home prices could take a serious dip. But what does this all mean for home buyers and sellers? Stick around to find out what the 2025 housing bubble really looks like. In 2024, the road to cheaper mortgages seemed like a clear-cut path. Inflation would go down, the Federal Reserve would lower interest rates, and borrowing would become more affordable as we enter 2025. Simple enough, right? Well, not so fast. Housing experts are now pumping the brakes on that optimistic outlook. It's looking like the kind of drop in mortgage rates they were hoping for, and affordability is still going to be a big hurdle for buyers. To make things worse, high mortgage rates aren't the only thing tripping up aspiring homeowners. Back in 2022, mortgage rates went up, home prices hit jaw-dropping record highs, and the inventory of available homes became very scarce. While rates have since come down from their 8% peaks, the fall has been more of a slow crawl than a quick slide. Over the past year, the average 30-year fixed mortgage rate has wobbled between 6.5% and 7.5%. Economists have been counting on rates dipping to around 6% by late 2024 and inching into the mid-5% range in 2025. But just when it seemed things might get better, rates took another jump and are teetering along 7% again. It's a roller coaster and not the fun kind. Forecasts now show that average 30-year mortgage rates will likely stay in the mid-6% range for a while. It might even float between 5.75% and 7.25% for the year. Some economists believe that policies proposed by President-elect Donald Trump, like tax cuts and big tariffs, could increase demand, boost deficits, and reignite inflation. This might lead the Federal Reserve to hold off on cutting rates, keeping borrowing costs high for longer. Trump had promised to bring mortgage rates back to the pandemic-era low of around 3%, but that's pretty unlikely. Mortgage rates only drop that much during tough economic times, and since the economy is doing fairly well, the Federal Reserve isn't planning many rate cuts this year. But here's the twist. Mortgage rates are not entirely in the hands of the Fed or the White House. It's actually up to lenders and, more specifically, the bond market, which reacts to future predictions rather than the current situation. Mortgage rates are super connected to the 10-year Treasury bond yield. Bond market investors are the ones driving those yields up or down based on what they think will happen in the future. It's all about predicting the future, not what's happening right now. The chief economist at the US Bank explains that if inflation expectations rise due to things like Trump's policies, bond yields and mortgage rates are likely to go up too. Now, how much can mortgage rates change in a year? Well, mortgage rates can swing a little or a lot depending on how the economy is doing. Typically, rates don't change dramatically unless something big happens, like a major economic crisis, inflation going crazy, or a recession. In such cases, bond yields can jump or drop a lot, which sends mortgage rates in the same direction. Back in 2022, mortgage rates jumped from around 3% to over 7% in just 10 months, thanks to skyrocketing inflation and the Federal Reserve's sharp rate hikes. That's a crazy 4% increase in less than a year. Fast forward to 2024, though, and the change is much less dramatic. The difference between last year's highest rate, 7.33%, and lowest point, 6.1%, is only about 1%. In 2025, we might see mortgage rates stay in a similar narrow range if the economy continues to grow steadily and there aren't any big surprises. But a new presidential administration, changes in global politics, or a resurgence of inflation could shake things up and cause rates to swing by more than 1%. For example, if the US goes into a recession and inflation drops significantly, we might see mortgage rates fall to the 4% range. If the economy stays strong, inflation sticks around, and the national deficit grows, we could see mortgage rates rise to 8% or even higher. So what could make mortgage rates go up in 2025? Well, the culprit is likely going to be the same thing that caused rates to jump in 2022: inflation. Inflation is a big deal because it's a key indicator of how the economy is doing, and it heavily influences the Federal Reserve's decisions on interest rates. Inflation also affects the bond market, which plays a major role in setting mortgage rates. When inflation is high, investors are less interested in long-term bonds, which causes their prices to drop, and in turn, mortgage rates go up. One potential factor that could fuel inflation is former President Trump's proposals, which include a 20% tariff on all imports and a possible 60% tariff on Chinese imports. If these tariffs become a reality, they would likely push prices up as businesses pass those extra costs on to consumers. Plus, tax cuts could shrink the government's fiscal revenue and increase the national deficit, which could drive bond yields higher, further raising mortgage rates. Now, the Federal Reserve has set a target for inflation at 2%. If inflation jumps well above that in 2025, the Fed might hold off on cutting interest rates, which would keep upward pressure on mortgage rates. On the other hand, what could cause mortgage rates to drop in 2025? Well, while it's still possible, a few things need to fall in place for rates to go down. First, assuming Trump's policies don't end up making inflation soar, we'd need a weaker economy, which could include things like a drop in jobs and a decrease in 10-year Treasury yields. If unemployment goes up or hiring slows down a lot, then borrowing costs, including mortgage rates, could go down. The Fed usually responds to tough economic times by cutting interest rates, and banks tend to pass on those rate cuts to consumers, making long-term loans like mortgages cheaper. If that happens, we might see 30-year fixed mortgage rates dip just below 6%. However, it's unlikely rates will fall much lower than that unless new economic policies also help reduce the government's debt deficit. So there's a chance for lower rates, but only if certain conditions play out. But even if average mortgage rates were to reduce by 1% in 2025, it wouldn't make home buying affordable for most Americans, particularly low and middle-income households. Since 2020, home prices have increased by more than 40%, and while home price growth has slowed some, it's still up 5.1% on an annual basis. Prices are expected to increase by just under 2% in 2025. The housing market in 2025 will likely continue to be an issue for many home buyers, especially those in low to middle-income households. While there might be a slight fall in mortgage rates, it might not be enough to make homes affordable for most people. Mortgage rates have a significant impact on how much a person can afford to borrow, and when these rates rise, it becomes more expensive to buy a home. Since 2020, home prices have increased substantially, and even though the rate of increase has slowed down, home prices are still rising by over 5% annually. This ongoing price rise is partly because the market is facing a significant shortage of homes. Somewhere between 1 and 4 million houses are missing from the market, which drives prices up. The shortage is also due to several other factors, though, including high construction costs and strict zoning rules that have slowed down new home building. Additionally, many homeowners currently have mortgage rates below 5%, which makes them less likely to sell their homes and trade them in for a new one with a higher mortgage rate. This creates a situation where the market is essentially locked, with fewer homes available for buyers to choose from. And on top of all that, inflation and employment play a big role in shaping the market. High inflation means that goods and services become more expensive, which erodes people's purchasing power. On the other hand, lower unemployment rates can boost confidence, leading to increased demand for homes. If unemployment rises, however, people become more cautious, reducing the demand for homes and making the market slower. But one of the biggest motivators of the housing market is inventory, the number of homes available for sale. When there are fewer homes, prices go up, making homes even less affordable. And while rising incomes can help, they haven't been enough to fully offset the high prices and mortgage rates. Looking ahead to 2025, it's possible that mortgage rates could dip a bit, which might give buyers some breathing space, but overall, with incomes not expected to rise as quickly and home prices still on the rise, the housing market will remain tough for many would-be homeowners. Experts are hopeful that housing inventory will improve in 2025, but it's going to take years before we catch up with the shortages from the past few years. Now, if you're one of those hopeful house hunters sitting on the sidelines waiting for mortgage rates to drop, here's the thing. A lot of the big economic factors affecting the housing market are way beyond your control. The decision of when to buy ultimately comes down to whether you're financially ready to take the plunge and manage the costs of home ownership. At the end of the day, whether you choose to dive into the housing market in 2025 or wait it out comes down to your personal financial situation. While it's tempting to hold on for the perfect moment, it's important to focus on what you can control, like saving for a bigger down payment or improving your credit score. The market is unpredictable, and making sure you're ready when the time comes will always put you in the best position. Stay informed, be patient, and remember, buying a home is more about your readiness than timing the market perfectly. That's all for this video. 2025 housing bubble, higher interest rates will collapse home prices, What effects do you think it'll have on the average American? Let us know in the comments section and enjoy our other videos.